You're listening to the Shaughnessy Group podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
Welcome back to the deep dive, and thank you so much for joining us. We have a really interesting set of source material in front of us today. It focuses on something that, for a private owner, is, well, it's often their most important asset, but also maybe the least understood. We're talking about the business itself.
That's right.
Okay, let's unpack this. We're doing a deep dive into insights from the Shaughnessy Group on the critical need for independent business valuation. And our mission today is simple. We want to explain why every single business owner needs to know their objective enterprise value.
And not just a gut feeling.
Right. Not a gut feeling or some multiple you pulled from a trade magazine, but a real verifiable number, even if you're not planning to sell tomorrow.
And that's really the core issue the source material gets at. I mean, we so often see owners who operate under this assumption that they know their company is worth better than anyone.
Which feels logical, right?
It feels logical, but it's often clouded by emotion, by wishful thinking. And if your expectations about value are never really challenged, they become the foundation for your future plans.
And if that foundation is shaky,
the whole thing can come crashing down.
So an independent valuation really has two jobs. It's that objective reality check, first and foremost, but it's also the data-driven starting point for any big strategic move you want to make.
Precisely. It's about protection, and it's about planning. This isn't just a document you get when you decide to sell. It's an active management tool.
Okay, but let's tackle the skepticism head on. Someone listening might think, why pay a third party when I have a great CFO? My bank looks at my books. What exactly is an independent valuation? What does that third party bring to the table?
Well, the values in two words: objectivity and specialization. An independent valuation, it's not just internal accounting.
It's more than that.
Much more. You're retaining a professional third party whose entire reputation depends on being impartial. They're not just checking your ledger. They are putting your whole business under a microscope.
So what's in that scope? What are they seeing that an owner might be, well, either intentionally or just unintentionally ignoring?
Well, they conduct a two-pronged analysis. First, there's the external analysis.
Looking outside the company.
Exactly. At market conditions, industry trends, what other similar companies have sold for. It puts your performance in a real-world context. Then second is the internal analysis. And this is exhaustive.
The deep dive.
The true deep dive, yes. Assets, liabilities, depreciation, historical performance, operational efficiency, and this is crucial, the quality of your earnings.
Okay, so they have this mountain of data, the internal report card plus the external market analysis. How do they actually calculate the number? I imagine it's not just a single calculation.
No, that's absolutely right. The professional then applies specific valuation methodologies, and they choose them based on your industry, your circumstances, all to arrive at what the source calls a reasonable opinion of value.
A reasonable opinion. I like that phrasing.
It's key. And here's a really important detail for you, the listener. If they only use one method, you should be asking questions.
Why is that? Can you maybe walk us through the main methods they use and why more than one is so important?
Certainly. There are three common approaches.
Yeah.
You have the income approach, which is often a discounted cash flow, or DCF.
For looking at future earnings.
Right. Then there's the market approach, which compares your business to similar sales. And finally, the asset approach, which is basically the value of your assets minus your liabilities.
And you need more than one because they tell different stories.
Usually different stories.
Yeah.
For example, if you run, say, a fast-growing software company with very few physical assets, the asset approach is almost useless. Your value is all in future revenue.
So the income approach is king there.
It carries almost all the weight. But now flip that. If you own a manufacturing plant with millions in equipment and real estate, well, suddenly the asset approach becomes very, very relevant alongside the others.
That makes perfect sense.
Yeah.
Using multiple methods just gives it that rigor, that defensibility, so all the stakeholders, partners, buyers, even a judge,
Right.
They get a full picture. Okay, so we've covered the objectivity and the methodology, but this valuation isn't just a number to stick in a file. Let's pivot now from that, defensive, know your number posture to the proactive side.
The growth side.
Exactly.
Okay.
Here's where it gets really interesting. How does this process actually help an owner put more money in the bank over the next 5 years?
This is my favorite part because the valuation stops being a compliance document and becomes a strategic one. The process itself forces you, the owner, to see your business through the eyes of a professional buyer.
And that perspective, I imagine, uncovers some gap.
Critical gaps and very specific opportunities.
Okay, give me an example. What's a specific gap a good valuation report would call out?
A good report won't just say, diversify your customers. It will quantify the risk of what we call customer concentration.
So if one client is too much of your business.
Right. If, say, more than 25% of your revenue comes from a single client, the valuation will apply a pretty significant discount to your enterprise value.
Yeah.
Knowing that quantifiable risk, it immediately tells you what your sales strategy needs to fix.
So it's a quantified roadmap for increasing your multiplier, not just generic advice.
Exactly. And that roadmap is pure gold when you start talking about attracting outside money.
Ah, okay. So attracting equity, investment, private equity, VCs.
Almost impossible without it. A recent high-quality independent valuation signals professionalism and transparency right out of the gate.
What does that report signal to, say, a venture capital firm?
It signals that your financial data has been vetted by an impartial third party. It lowers their due diligence risk. It clearly shows them your financial health, your structure, and, your real future growth potential. It lets them understand the basis for your price.
And I'm guessing this applies even when you're just looking for a loan, not selling off a piece of the company.
Precisely. For debt financing, too. If you need a loan to buy new equipment or maybe remodel, presenting the lender with that professional valuation just streamlines the entire process.
It gives the bank confidence.
It gives them confidence that there is a verifiable asset backing the loan, assessed by an expert. You are minimizing the bank's perceived risk, which helps you get a yes faster.
And then, of course, the most obvious reason, actually selling the business. All these other things make the business better, but they all lead to that moment you set an asking price.
It's the natural culmination. The valuation gives you that objective market assessment. It gives you, the seller, just immense confidence in negotiations because you're armed with facts, not feelings.
And it gives the buyer confidence, too.
It assures the buyer and their lenders that the price is justifiable and rooted in reality.
We've covered the proactive, forward-looking reasons, the growth, the financing, the sale, but now we need to shift gears and talk about the necessary, often unavoidable reasons, the life event scenarios.
Right. This is valuation for protection and transition. And these can be the most high-stakes, stressful situations. The reality is, every owner will exit their business one way or another.
An evaluation helps you plan for that future. It gives you a baseline.
A critical baseline. It helps an owner answer a very simple but sometimes terrifying question. Can I actually afford to retire?
Oh, yeah.
The valuation reveals the gap between what the business is worth today and what the owner needs for their future goals. If there's a gap, now you have a defined, measurable target to work toward. It turns a dream into a financial plan.
Let's talk about internal ownership changes.
Yeah.
Super common, and nothing causes conflict like money, especially between partners.
It can get messy.
So when a partner wants out or a management team wants to buy in, how does that third party keep things fair?
That need for fairness is precisely why they're called in. Take a management buyout, an MBO. The older generation is selling to the current management team.
Okay.
That team retains a professional to determine a fair buyout value. If they tried to set the price themselves, it would be a nightmare of legal challenges and distrust. The independent expert just removes that conflict.
And it's the same principle if one partner is just leaving. The remaining shareholders need that unbiased number to buy out their shares.
Exactly. It's about fairness, robust documentation, and maintaining the integrity of the firm. And that need for clear documentation leads directly into estate planning.
Protecting the company's future if something tragic happens to the owner.
Precisely. If you need to execute a succession plan quickly, passing the business to a family member or a key employee, a recent valuation with up-to-date financials is critical. Without it, the estate can be tied up for months.
It just gums up the works when time is of the essence.
It does. A valuation helps the successor get the estate in order cleanly and quickly, making sure the business actually survives the transition.
The source material also mentions value protection outside of succession, things like insurance.
Yes. A detailed valuation helps you figure out the proper amount of insurance coverage you actually need. And if there's a major event like a fire or a natural disaster, that valuation provides the benchmark for your claim. It's also used in co-owner life insurance agreements to set the payout amount.
Okay, and finally, we have to touch on the most sensitive use case, but one that is absolutely critical: divorce.
Yeah, this is often where emotions run the highest. The business, if it was built or acquired during the marriage, is an asset to be divided. An unbiased professional valuation is really mandatory.
Has to be objective.
It has to be. The valuator provides clarity for both parties and, just as importantly, helps the court make an informed, non-emotional decision on how to distribute that asset fairly.
So what does this all mean? When we sum up all these reasons, from growth and investment to just protecting yourself from life's curveballs, the real theme here seems to be proactive risk management.
Vigilance is the perfect word for it. It's just like managing your personal health. You don't wait for a crisis to see a doctor. You get regular checkups.
You have to be initiative-taking.
You do. The valuation process gives you that deep understanding of your risk profile, and more importantly, it identifies your true valuation drivers. That knowledge is what guides every successful strategic plan.
The ultimate goal, then, is to get that independent assessment at regular intervals. It's really the only way to consistently protect and grow the value of the business.
Don't wait until the crisis hits. Don't wait until the negotiation starts. Make it a standard rhythm in your business cycle.
Now, building on that summary, the source material points out a fascinating distinction that I want to leave our listener with. The difference between price and value.
Yes. This is pivotal.
So if the valuation scientifically determines the value, what the business should be worth, and the negotiation with a buyer determines the final price, what someone will pay, how much distance is acceptable between those two?
And that is the question that defines a successful transaction. Value is based on data. Price is based on agreement. How good is your strategic plan at closing that gap?
Are you fixing those risks you identified?
Exactly.
Yeah.
The customer concentration, the key person dependence. Are you fixing those things so that when you sit across the table, the buyer has no ammunition to argue for a lower price? That's the real power here.
That's a powerful thought to end on, a real call to action for owners to look inward. Yeah. Thank you for walking us through all of this. It's clearly not optional homework for any private company owner.
My pleasure. And I should say, the insights we shared today came directly from the Shaughnessy Group. They specialize in helping business owners successfully transition their privately held, lower middle market companies.
And we really appreciate the depth and the real-world clarity they provided. For those of you listening who want to explore this further, they have a comprehensive guide. It covers preparation, methodologies, and common valuation mistakes to avoid.
It's a tremendous resource.
To get those resources, please visit shaughnessy.group. That's SHAUGHNESSY.group. We'll see you next time for the next deep dive.
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.